We build projects and we manage projects that deliver power. Increasingly these days, the emphasis is on the carbon intensity of that electricity as countries look to decarbonise their power systems. Lower carbon to us is really primarily about gas as a transition fuel these days. So using gas as a fuel in power generation, in our particular approach to it, it's more at the medium scale, behind the meter we call it, or distributed power configurations, as well as renewable energy. So when we talk about lower carbon infrastructure in the power context, we're really talking about gas as a transition fuel. You've got more choices now than you've ever had. We've always believed, as developers ourselves from prior experience, that the decarbonisation of power systems really requires a significant new build out of cleaner, more efficient assets. So we've always been involved in asset creation, so building new projects. That requires us to manage more risks like late stage development risk and construction risk, and you'd expect a higher return for that. So the risk adjusted return opportunity in what we now call value add infrastructure is one area that investors can participate in. That means bringing these assets into being. And particularly when we're seeing more emphasis now around ESG factors and sustainability and impact investing, a lot of institutional investors want to participate in that asset creation cycle. The other areas that you can play are in acquiring established assets. There's a lot more M&A activity going on, and there's plenty of assets to acquire. These are assets that are already operating, if you like, and therefore they're somewhat de-risked. So an investor can decide that they want to play only in the de-risked asset space. As the stock of assets in the sort of clean energy sector has grown, so there's more assets around, there's more assets that have been levered, and there's more participants, some accomplished operators, some not so accomplished operators, as you would expect. Sometimes things go wrong and either assets are over levered or they're poorly operated. And so we're seeing with that increased stock of assets, particularly those that have been built in the last 5 years, we see restructuring opportunities. And that's an opportunity for us to essentially take over from someone else's mistakes or someone else's misfortunes and rebuild those assets and bring the assets back to their operating potential. One of the particular features of the US market from an investing in clean energy perspective is the federal tax incentives. Here in the US, you can monetize those tax benefits through upfront capital transactions. So in other words, you can bargain for those tax incentives with a US taxpayer, and then that becomes part of the capital injection into the project and is an important feature of how you derive your risk-adjusted returns. If you're a non-US investor or a US institution that's tax-exempt, the monetization of those tax benefits is really critical. If you're a non-US institutional investor, it's very, very important to be able to structure the projects in such a way to maximize the benefits that you can't otherwise earn because you're a non-US taxpayer. And so being able to structure those transactions and having the experience of doing that as an investment manager is really, really critical. We're also not seeing the long-term contracted arrangements that we used to see. So a 20-year or a 25-year purchase commitment, whether it's from a utility or whether it's from increasingly a corporate buyer, are certainly more rare, and therefore the projects are, by and large, becoming more exposed to the vagaries of wholesale markets. So there's certainly a degree of commodity risk that's creeping into your overall analysis of a project, and one would say that's a natural evolution of, if you like, renewables getting to grid parity. So in other words, becoming just a part of the power mix, like a coal-fired power station or a gas-fired power station, and not being treated as a sort of a special subsidised asset class anymore. Therefore, you've got to look at what is driving pricing outcomes in those power markets, and long-term, both short, medium and long-term.